Will investing in the HDFC Life Sampoorn Nivesh plan help you in protecting your family financially and in achieving your financial goals in the long run? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So this is a unit-linked non-participating life insurance plan. Some of the key features of the policy are your premium payment can be customized as single, limited or regular payment, and you have the flexibility to choose your investment term from 10 to 35 years for single pay and 85 minus age at entry for limited or regular pay options. And you have the choice for 3 benefit options to suit your requirement, and also there is an optional accidental benefit available. And there are loyalty additions to enhance your fund value after 10 years. And you can also choose from a range of 10 fund options, and there is reduced premium allocation charge for the higher premium amount. And there are benefits like maturity benefit, death benefit and partial withdrawals. Lump sum partial withdrawals from your funds are allowed after the completion of the 5 policy years, and the maturity benefit is something the policyholder will get once the policy matures at the end of the chosen policy term and all your risk cover stops. So you may, as a policyholder, redeem your balance amount at the then prevailing price of the unit and take the fund value as your maturity benefit. Or you can also take your fund value at maturity in periodic installments. And we have a small tabular column presenting here to indicate the different death benefits for each benefit option. So for each benefit option, the death benefit differs. So death benefit is something, unfortunately, if the policyholder passes away during the policy term, then the nominee or legal heir will get. So what is the death benefit is mentioned on here, which will differ based on the benefit options that you have opted for in the inception of the policy. So these are some benefits, and there are also various fund options like equity plus fund, diversified equity fund, blue chip fund, opportunities fund, balance fund, income fund, bond fund, conservative fund, discovery fund, equity advantage fund, flexi cap fund, mid cap momentum fund, nifty alpha 30 fund and top 500 momentum 50 fund. And all these fund options, as you can see presented on the tabular column, are categorized based on how much percentage of allocation they have allocated to each asset classes like money market, cash and deposits, or government securities, fixed income, bonds or equity. And also according to the risk profile each fund has, they have categorized, which can range from low to very high. So you can choose the fund options based on your risk appetite and financial goals and what kind of time horizon you want to be invested. And it has also various charges that you need to pay for if you invest in this policy. So the charges are premium allocation charge. So this depends on your premium amount and mode of payment. So in the initial years, the percentage of premium allocation charges will be higher. From the 6th year onwards, the percentage is constant throughout the policy term. It ranges between 1 to 9%. And it also has fund management charges of only 1.35% per annum charged daily of the fund's value. And it also has a policy administration charge which is subjected to a cap of 500 rupees per month. So this also differs on what policy year you are and what kind of premium payment mode you have chosen. And it has also other charges on mortality and other risk benefit charges and miscellaneous charges, which will attract a charge of 250 rupees for the policyholder for per request. And they also have discontinuance charge, which will depend on the year you choose to discontinue and your premium amount. But there is no charge after the 5th policy year. And there are 4 free partial withdrawals in each policy year, but subsequent partial withdrawal will attract a charge of 250 rupees per request. But if requested through the company's portal, then the policyholder will be charged 25 rupees per request. And it also has 4 free switches in each policy year, but subsequent fund switch request will attract a charge of 250 per request. But as I already mentioned, just like partial withdrawal charge, if it was also requested through company's portal, the charge will only be 25 rupees per request. And same applies applies to premium redirection charge. So these are all the various charges that you need to be paying if you choose to invest in this policy. This is also kind of a drawback because if you think about it, they are not going to charge you these charges based on your gains. They are going to charge these charges from your premium amount, like your capital, then only they are going to invest in it. So in the long term period, the returns you might get will be potentially reduced. So this is a drawback that you need to be mindful about and carefully consider before deciding to invest in this policy. Now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are the policyholder can avail of the settlement option for maturity benefit with periodical installments over a settlement period which may extend up to a maximum of 5 years. And it also has rider options like accidental disability rider, critical illness plus rider and protect plus rider. These can be availed to enhance your base policy cover, and partial withdrawal is allowed after the lock-in period of 5 years. And if you have opted for the classic plus benefit option, then there is an option to receive both your sum assured and the fund value in case of death. And the accidental death benefit is equal to your sum assured, which can be added to the classic benefit option. And also under the classic waiver benefit, even after the death of the policyholder, the policy continues without any premium payment and the fund value is payable on maturity. So there are 4 free partial withdrawals, premium redirection and switching allowed in a policy here. So the disadvantages are there is a lock-in period of 5 years for surrendering and partial withdrawal, and there is no loan facility in this policy. The premium is routed to investment after the deduction of various charges, as I have already mentioned. So some of the charges like discontinuance charges, miscellaneous charges, etc. are exclusive to ULIP products. This will affect your yield in the long run. So if you take other examples like mutual fund, for example, they will not charge these many charges like how this ULIP policy is charging you for investment. And there is no bonus addition to the fund value in this policy. Loyalty addition starts only after the completion of 10 policy years. So you need to keep in your mind all these drawbacks and carefully go through them before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let us move on to the analysis part of the video. So ULIP involves the active management of funds. So actively managed investment should yield better returns than fixed income instruments. So with this information, let us now calculate the internal rate of return IRR of this policy based on the figures given in the policy brochure. So for calculation purpose, let us assume that a male of 30-year-old purchases this policy with a sum assured of 20 lakhs, policy term of 40 years and premium payment term of 10 years. So the annualized premium he is going to pay for 10 years is 1 lakh. So this following table presented on the screen shows the maturity value at the end of 40 years, which is calculated based on 2 future assumed rate of return. One is 4% per annum, another is 8% per annum to indicate the worst and best case scenario. These are not guaranteed returns. This is just to give you an idea of how this policy can perform at both end of the spectrum. And also it shows you the IRR for the classic benefit option, which is the policyholder has chosen in this example. So the maturity value is 18,12,776 rupees at 4% per annum. So the IRR comes around 1.69%. And for the 8% scenario, the maturity benefit is 87,13,442 rupees and the IRR is 6.24%. So if each year an annual premium of 1 lakh is paid for 10 years, you get a maturity value of these options. So in the best case scenario and in the worst case scenario, similarly you can see that it all comes around 1 to 6%. So these rates, especially the 1%, is not even similar to a rate of interest you can get from a savings bank account, and 6% is equal to the fixed income rate of returns. So this policy, as I have mentioned before, involves active management of investment, but the return is similar to any fixed investment return, which does not compensate for the risk the policyholder has taken by investing in this ULIP. So any investor, whether a new buy or a seasoned investor, will never stop in the quest for better yielding returns. So comparing the return of this policy with other investment options will give us a clearer picture of which is a better alternative. So we are going to take the same metrics from this policy for a fair comparison in an alternative strategy. So instead of coupling insurance and investment, we are going to separately invest in insurance and investment by allocating the same premium efficiently into these separately, just to see whether we can get better returns in this strategy. So for life insurance purpose, we have opted for a pure term life insurance policy for life cover of 20 lakhs for a premium paying term of 10 years, which will only cost us 25,900 rupees of the annual premium compared to the 1 lakh we paid in HDFC policy. So out of the total amount of 1 lakh, the balance amount will be 74,100 rupees, which we can invest in either PPF or ELSS based on a risk profile and a risk appetite. So if you're a high risk investor, you can choose ELSS funds, or if you're a low risk investor and want something low profile, you can invest in PPF. But here we have, for a better understanding of your choices, consider both the options. So we have a combination of term insurance plus PPF and another combination of term insurance plus ELSS mutual fund. So PPF's IRR is 6.21%. So 6.21% is a guaranteed return. But in the case of HDFC Way Life, which is similar to the 8% benefit illustration, you can see that it was not a guaranteed return. But here, without even taking any risk, we can get a guaranteed return of 6.21% for the term insurance plus PPF combination, and the IRR for the term insurance plus ELSS combination is 10.68%. So after 40 years, the maturity value in PPF is 86.20 lakhs and in ELSS it is 3.82 crores post-tax, which is. So if you want to know how the post-tax calculation is done in for ELSS, we have also a presented separate small tabular column for that on the screen for your reference. So we have better yield when we split the life insurance cover and investment option, but in the policy like HDFC policy, your hands are tied in the initial 5 years, and also the potential investment return is below average for actively managed funds. So expert analysis of aspects like fund value, fund performance and benefits and calculated returns show us that it is below average for an actively managed fund investment. So what is the final verdict? Is investing in the HDFC Life Sampoorn Nivesh plan worth investing or not? This policy offers flexibility in choosing the death benefit with 3 options and fund with a choice of 14 fund options. You can switch your fund according to the fund performance, but after analyzing the IRR under various plan options, it shows that the returns are not inflation beating. All ULIP policies in the bazaar are advertised promising they will provide benefits of life cover and market linked returns on investment, but that's not the case here because high mortality charges and other investment charges are deducted from your premium and the net premium is only invested. As a result, at the time of redemption, the fund value will be low. But why do insurance agents still pester you to buy this plan? The answer is quite simple: because of the high agent commission that they get. So ultimately, any investment should help you see your savings yield rich benefits and help you to accomplish your life's financial goals. To accomplish your life goals, analyze the scheme before investing your hard-earned money. Always keep your life insurance and investments separate to achieve better results. Don't fall for misleading information on social media platforms like Facebook, Quora, Twitter, etc. You can always consult with a professional like a financial advisor for guidance and customize your financial plan according to your risk appetite and financial requirements based on the guidance of a professional like a certified financial planner.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.